Resnik, Chief Executive Officer of FinaMetrica. Paul, the floor is yours. I'd like to hand over the mic to you, or the sound.
Yeah, can you hear me, guys? It works excellent. Good afternoon, everybody. Or as we say in Australia, good eye. Can you practice back? Good eye. Hold your nose. Good eye. It means good day. We're very quick to shorten language in Australia. I'm hopefully over the next hour, I'm going to paralyse you with wit and intellectual challenge. If I don't, feel free to doze. It will not be taken personally, but I will throw something at you if I spot you. I've been given an hour today, and I've been pondering what we should do during that hour. So what I'm going to take you through is essentially a trip through the philosophy of good advice. So that this is going to be a very intense hour. There are lots and lots of concepts. Please take this as sharing. I have little understanding of the complexity of Dutch culture and what you're growing up with, but I do, however, have a good understanding of how suitability, the matching of investments to the needs of customers, works around the world. So what you'll get is my perspective, my business's perspective on risk tolerance and the role it has to play. Now, for many of you, you may think, well, it's just risk tolerance. Of all of the things that we do in our business, wherever you sit in the service and supply chain, you may think, well, risk tolerance is just a little bit. I can just unplug whatever I'm doing, which might not necessarily work very well, and plug in something that will be a bit more defensible in the light of the new regulation. You may think that. Hopefully at the end of this hour or so, when we've had a chance to show how the integration works in the main software, you'll have a different view that when you do it properly, as we would argue, when it's done with intellectual academic rigour and with a commitment to the client, that it's well worth doing as well as you could do it. So if we start off with this image, in essence, this is where we want to get to. This is where we'd like our client to be. Yeah? In the financial planning process, you should be able to say, it's done. It's external to me. I know whatever happens, there will be assets available for my family and me, whatever the circumstances. For younger people, that will include insurance. We all self-insure. Our natural position in life, what are we? We're all insurance companies. We choose, if we're fortunate, to outsource some of that risk, don't we? We give it to a general insurer to insure our car, or a life insurance company, if we're insuring our life or our income. So we're all insurance companies. The mixture of suitability for younger people is this balance between understanding somebody's liabilities and asset matching. Bit of insurance, bit of self-insurance, and a little piece of investment. I'd like to believe that for all of us in the service chain, this similar model exists. We would all like to sleep at night knowing that what we've done for our clients also enables us to feel comfortable, knowing we've done the best job possible. Plan Plus Global is the owner of FinaMetrica. FinaMetrica and Plan Plus merged in August last year. So we are still at that stage of seeing whose elbows are sharper. For those of you who have ever been involved in a merger of equals, you will know that sometimes some elbows are sharper than others. Plan Plus was one of our clients. We had an integration. So if you imagine two businesses, we looked at the psychological preference for risk. Plan Plus was one of our integration partners. They were a calculator of risk. They did asset liability matching. We've been integrated for 10 years. It was a natural merger. Many of you looking around the room will be old enough to understand that there is no value in a small business. It is just an indulgence allowed of us. You need to be of reasonable size for a business to have any value, and putting the two businesses together was a natural progression to do that. In our case, we'd both been involved in a really rigorous academic and intellectual pursuit of what could be best. Invariably, if you're from a small country, you know you have to export to actually make a living. It's worse when you're from Australia. At least here, the borders are, you can walk across them. It's a 24-hour trip for us to get to the UK, which is our natural marketplace, because we actually speak something similar sort of English. It's not much better to get to New York. These are long, long trips. So we would argue that putting the two businesses together was simply a way of making sure we understood and could offer our clients. The way we've separated the business, we're now, in the language of contemporary life, we're a series of algorithms with some attached APIs. You can choose something out of our intellectual process. So we have one international bank, as an example, who has just chosen our international tax calculators. We have, because we do calculations of cash after tax, we have to be able to do cross-border. So that gives you a view of Plan Plus. What we're going to do today is cover an enormous amount of stuff. So sometimes I'm going to speak very quickly. I'm going to look at the evolution of advice, the argument that money follows emotion, it's not rational. What's risk tolerance? What's a risk profile? Risk tolerance is psychological, risk profile is the wider personal definition of what's needed. Typical mistakes, so that you can see, I can share with you at least some of the flaws that exist in existing or even potential risk profiling approaches you take. Some global trends and advice. My favourite argument is we get the regulation we deserve. You know, there is a reason why we have MiFID II. It's not because God doesn't love us. And can I tell you, around the world I get these three arguments when I talk to people. People say, I need to tell you three things. Maybe two. We're different here. We're different. Two, the regulator understands nothing. Now, I share that with you because it may actually be different here, but essentially it is the same problem around the world. How to get suitability, how do we engender trust? Why is there a benefit in it? It is the oil of liberal democratic capitalism. If you don't have confidence in saving, money will leak to other spaces. If it does that, that tends to be inefficient. You want money in the system. You want people to be able to set up businesses, employ, pay taxes. It is a fundamental issue. So when we talk about this at the biggest level, we cannot afford for there to be any lack of confidence in the saving. And that's the global argument. If you want to stay in power as a government, you need to have employment. Fixing up financial services so people don't do as they do in India. 4% of savings in India goes into capital markets. The rest goes into gold. That's helpful. Term deposits that earn 3% less than inflation. Inflation's 8 or 9%. And property. Yeah. We get the regulation we deserve. I'll talk a little bit about MiFID. I'm blessed. Unlike almost everybody else who actually has to apply MiFID, I just read about it and talk to people. So I can share with you at least my perspective. I've just spent 2 weeks in London talking to people in the service supply chain about what's happened to them in the introduction of MiFID II. I want to talk a little bit about value of trust, and then the fundamental issue, the propositions of intimacy. In the end, we're all in the intimacy business because technology will be the same for all of us. It is our ability to touch and leave a relationship that is the permanent value of our business. So In one of my more vulgar moments, I say, we are part of a mass intimacy process. You need to have good process about it. And then a couple of sort of examples. So there's an inordinate amount to cover over the next while. I may just start with what I call the evolution of advice. Now, all of these slides will be available. I'm conscious that the screen may be too small and I've given you too much detail. So if you do get sort of overwhelmed, don't read, just listen. And these slides will be available. I think what I'm trying to define here is the cycle has got us to where we are. And it's like a pendulum that swung too far. If we started off with financial services as a prime example, we had caveat emptor, buyer beware. There is a symmetry of knowledge. If you're stupid enough to buy my product, that's fine. That it will gouge high fees and not deliver on its promise is fine, because there's always somebody else. Best epitomised by America, yeah? Now, much to my shock, this seemed to apply in Europe as well. The banks and other financial institutions, when I talk with advisors, tell me a similar sort of process. No great sense of fairness. Now, the natural response to that is what we see in MiFID, which is paternalism. A whole bunch of, we would describe them, white Anglo-Saxon blokes sitting in a corner say, we know what's best. And you get highly prescriptive solutions. Golly gosh, does that remind you of MiFID II? They may be nonsense, but they are prescriptive. When we go to principles, which is where we would prefer to be, it's too ambiguous. So there's this terrible balance. So what's the middle ground, or what's the alternative? Well, the alternative sort of sits in MiFID. It's saying, what we're trying to do is to make things transparent. So what's the benefit of transparency? When things are transparent, you have a much greater likelihood of making an informed decision. Okay. So if it is relevant transparency, conflicts of interest, and the three most obvious ones of ownership, because they cause conflicts, fees, because that causes conflicts, commissions, if you will, and the likely volatility, the likely uncertainty of getting your money back in some cases. You say, well, if we can get those on the table, remembering that most of us are barely numerate. Now, we in this industry are barely numerate. Our clients, somewhat further disadvantaged, knowing that both of us, those skills degenerate with age. So the older you are, the more difficult it is to do calculations. On that basis, the only protection you can have, if you can't make the decision yourself with these transparent options, is to have fiduciary advice. Advice for the benefit of the client. Now, for most of the world, businesses are vertically integrated. Want to manufacture the product and sell it. And the great defence, when I look at how slow Europe has been, it seems to me it's been the enterprises and institutions defending the status quo. They have delayed it as long as possible. In other countries, it has moved at different paces. Now, the reason to have an independent advisory world is twofold. One is it gives you the potential for somebody to say, I want to pay somebody as a fiduciary, to act on my behalf, to help me in that judgment. But the other part, and the critical part, it is having a critical input. In the countries where there is no independent advice, rape and pillage is the order of the day. So, good. We start off with exploitation. We try to be too protective. Informed consent is where we are, and that's what sits in MiFID for the first time. Now, at any point of time, I can share this with you. This is the cycle of regulation. Yep. Markets will crash. And I did this last week. So I can claim absolute prescience, yes? You know the argument. You'll always be right as long as you don't change your mind. So we are about to have an all-time boom. That will be also true. Investors will lose money. Media and lawyers get excited, penalties and compensation will be paid, reputation's damaged, harsher regulation will be enacted, trust will be harmed, and then markets will boom. Now, for those with grey hair, this is a story you will have seen. This is my 50th year in financial services. So I've learnt this the hard way. This isn't a script. This is actually what happened. You can sit down and look at legislation and say, this was the event that drove these clauses. And what's the protection? I found this fantastic, if you can see the image on the right, the preventative maintenance monthly. I could not believe my good luck. I was looking for an image. Where would I found this? This is the American Army in the 1950s. And so many of these were sexist that I couldn't actually show. They had the traditional buxom soldiers. So I actually went through to find one that I thought was ideologically acceptable for this image. But that's all we're talking about. It's preventative maintenance. How do you make sure you don't get screwed over in the turmoil of regulation? It's not the regulation that you should follow. It's common sense. And common sense is suitability. You want to buy and sell things that meet your needs. No more, no less. We do that in so many other areas. Why is it in financial services that we think we don't have to apply the same rigour to running a great business? If you make bad shirts or bad shoes, people don't buy them. How do we get away with it in our space? We're not going to get away with it much longer, and it's preventative maintenance that will save us. As I said before, I've been around an inordinately long time, but there are moments where you learn something, and 87 for me was a critical. So this is the Wall Street Journal. Now, for those of you who remember the 87 crash, you won't see it if you look at account balances 31st December to 31st December. It was one of those, it's awful, but it's better. Quite different from 2008. But I happened to be a product manager in Melbourne, working for an English life insurance company, and I had the nearest office to the complaining customers who came in. Now, I had never met a customer. The great thing about life offices is if somebody actually came in, you worried they were out to diddle you. Don't know if any of you have ever worked in a life office. The presumption was it was so hard to sell life insurance that if somebody came in to want to buy it, they were obviously a suicide likelihood, or they had major illnesses. So we did everything possible to keep people away. And lo and behold, after the 87 crash, people started arriving at my office. They always seemed to be very bad-tempered. They always seemed to be from Yorkshire. Now, have you ever met people from Yorkshire? There may be a bit of Hollands like that. These are people that lack finesse, but are very clear in their expression of what they like and don't like. And I seem to have 100 of them, all with fat fingers sort of pointing down at my desk, saying, lad, this is rubbish. So what did I learn through that? I learned that there is a promise. There's an investment promise. I had been involved in drafting the offer documents. I knew what we call in Australia, are you familiar with this vulgar term, a bee's dick? I knew a small amount more than anybody else. Literally, I was skating. Somebody had drafted something before, like everybody, I photocopied what the other people had did, changed 3 words and claimed the genius that I got it out on time. 87 was an immense moment, because what I realised that if you don't frame people's investment expectations, they're going to get caught in the cycle and you'll get punished. And the thing about a life insurance company that doesn't exist almost anywhere else is you value clients properly. In most businesses, you look at matching revenue and costs as they flow in the door. So you look at a profit and loss, say over an accounting period, and you say, this client cost me 8,000 to get, but they've only paid me 5,000, therefore it's a loss, let's close that down. You don't do that in life insurance. You basically say, this client is going to be with us for an extended period of time. You bring to account the future flows and you compare that to the cost of acquisition. So it's a very smart way of doing business. It has its flaws, but essentially it enables you to say, if I treat my client with respect and they last with me for an extra year, what is the monetary value of that? And that monetary value comes out in the value of your enterprise, in your planning business, in your platform, whatever you do because most of us are in forms of subscription businesses. Your value of your business is the quality of the recurring income stream, or the level, the minimal level of non-renewal of your business. What I saw in '87 was it all blew up. Now, I went back to find something. I'd lived through it, but I hadn't actually gone back and researched. Once again, I went back. Are you familiar with Robert Shiller? Does that ring a bell? So Shiller was a very smart and obsessed man. Round the days round the crash, he sent letters out to all sorts of people asking for their responses. And his view of the end was, you know, this crash isn't data or algorithms gone awry or things being overpriced or underpriced. It was a congruence of emotion on the day. It was simply a crowd reaction. And I guess over the last week, have we not all been looking? I'm committed never to look at market because I know this serves no useful purpose. What did I do 5 minutes before I presented now? Just to have a quick look. So we get caught up, even when we know better. We can't help but get caught up in the emotion. If it happened in '87, will it not happen again now? The market goes. Now, what's the cost of it going? You may have seen something like this. Let me see if I can explain it to you. This is the MSCI, which is the black line here. And now let me get to the... So this is the MSCI. The green is the flow, net flows, new flows of money going into equity markets. This is 2000 to 2014. So you can see the line. As equity markets go down, so do the flows of money. As equity markets go up, so do the flows of money. That's US. So if we do not intercede in emotion, we get stock following. Now, there has to be a cost of that. Would you agree? Because we're not buying at the bottom and we're not selling at the top. So what do we think that cost could be? And there is huge discussion and debate about that. Maybe it's worth 1% per annum. That's a lot of money, yeah? For those of you that have done calculations and look at the effect of compounding over time. So if we can do something to compound... Now, I can't pick here who are the fund managers, who are the advisors of end customers, and who are the end customers. This is at least the combination aggregate of emotional investing of the market. I think it would be a reasonable argument to say that the end customer doing this is least likely to have done this successfully, but I could be proven wrong. You might well have some evidence that individual investors do better than professional investors, but I'll leave that with you to look at. So what's going on in the world? Well, this is what's happened. These are the pressures on the left and the responses on the right. As I said, I travel maybe 3, 4, 5 months a year, generally just trying to talk with people. I've tried not to impose my own view and to be patient and listen. This is enormously difficult when you're a bloke my age. I have opinions and I need to slam them down somebody's throat, otherwise I don't feel human. But I'm working at listening. So this is what I pick up. On the left are the pressures. Huge amount of regulation around the world. Questioning of active investment. and the rise of passive. And we can see that in America. I think Vanguard broke 90% of new business last year. So not only is it passive, it's just one manager. It just so happens to be Vanguard who stand out as the only mutual in the US of any consequence, and the ones that are, at least on the face of it, consistently moral. So there you see an example at its simplest level of virtue getting its reward. We have a growth of ETFs, exchange traded funds. Ironically, Jack Bogle, who founded Vanguard, thinks these are awful because he says they're used as trading platforms and not long-term investment platforms. Along the way, we're seeing product rationalisation. I'm sure it's no different here, but every time there's a whim in the air, there's a new investment and a new investment vehicle. 80% of investment vehicles never get to be adding any value, they're just a cost. So product rationalisation, some countries it's easier than others, I don't have any sense of here. But expense growth, margin reduction, and at the same time baby boomers have arrived. Now for those of us who are baby boomers, we're used to leaving a footprint. Every time we've touched anything, we've left a huge footprint. Many people would argue we've just stolen everything from every other generation. I'd like to think that's true. What does that mean? We've now entered a world that there is no experience. In worlds where you either died within 6 months of quitting work or work quitting you, you had defined benefit and you had generous governments for a while. All of that is now changing. Decumulation adds psychological risks, much broader set of risks because we've got to now deal with other assets. At what point of time, if you own a property, for instance, do you look at using that as an investable asset? Because if in the end you're going to need to rely on it, you shouldn't be relying on it when you have the worst capacity to make decisions when you're 80 and you've got no other money. So for no other reason than that, you need to start bearing in mind that that's a critical issue going forward. What are the responses? Everybody's talking about engendering trust. I was at a robo conference last week. The robo guys were saying, we have mechanisms to engender trust. It's called big data. We are going to manipulate people. You know, Richard Thaler got the Nobel Prize a few months ago for cheating people. Yeah. So we reward people now for being able to manipulate. Control of the customer journey. Is that language that's used here? We don't want people coming off the rails. We want to make sure that all of our promises are controlled and centralised. What's that? Suitability, isn't it? This investment meets your needs. How complicated does it need to be? Maybe nothing at all. It's the conclusion. It's the process to get to the conclusion where the value is. You maybe just be happy with nothing. And the money's quite happily in the bank. You don't need an investment to achieve your goals in your circumstances and needs. What we have along the way is technology and digitisation. There seems to be a robo conference every 3 months. Each time I go, there's another swag of great ideas, insights, and young people. I don't know if you ever go, do you have young policemen here that they barely look like they're shaving? And they're working as, they seem to be CEOs of startup tech businesses as well. I have never seen people so young and with such confidence that in the data is the secret of the future. Almost all fund managers are looking to widen their distribution capacities because they've been disintermediated over the last while, that they've lost relationships directly with end customers. And in a sense, one of the things that you can see emerging is the larger fund managers are vertically integrating back into distribution, certainly in the US, just as established managers are struggling with vertical integration. In Oz in particular, we had very strong vertical integration, abject failure of the highest order. The reputation of our vertically integrated banks has never been lower. There is a royal inquiry that started 2 weeks ago. And the first part of it, each of the banks has to admit in 5,000 or 50,000 words all of the errors and transgressions of the last 10 years. Those businesses are now removing their wealth manager, selling their life businesses, their planning business, their investment businesses. And finally, mergers and acquisitions. So we are talking about a melting point, if you will. I've been around for a long time. I have never seen so much uncertainty. And in the middle of it, I guess you're here today, you will be feeling part of it. I can't tell, I haven't spent enough time. I'm no longer a virgin in Holland. I've been here 24 hours. So I have a great empathy for the natural process. I've been to the zoo. So I can't talk with any confidence at all, but I can share with you my sense as I travel through. Now, let me go at the moment to risk tolerance, because I feel obliged. That was my topic. Just talk a little bit about it. Risk tolerance is personality. Okay? It is normally distributed as a good way of explaining it. Some people are risk averse, some people are risk tolerant, and there are some people in the middle. The way we've done it, as we can see here, is we have in our 25 question test, we have 7 risk groups, each a standard deviation apart. So the 2 outliers, 1 is low, 7 is high. 1 tend to be people that weren't brave enough to apply to school teaching as a career, and the 7s are people that have run a new absolute return fund every 6 months for the last 15 years, knowing that nobody will put them in prison. The vast majority of people are in the middle. Risk tolerance is persistent. Okay, that's another critical piece of this. It doesn't change with... So this is give or take 1 million test results on a monthly basis going back to 98. So the blue line here is males, red line females, and the green line, that's the MSCI. Remember I showed you before the money flows that follow the MSCI. As you can see, it's not being driven by changes of risk tolerance. It's been... the money moving is for a different reason. What do we think that might be? Fear and greed. Nothing profound in that. Emotion. It's not changed by circumstance. Now, for many of you, you'll go, that doesn't feel right. There is another Australian that's been drinking from the kangaroo spot. But, so what could it be? It's personality. It tends not to change. As you know your own person, as you know people, things can get exaggerated a little over time, but largely it doesn't change. So, what do we know? We've now got results, just 1.1 million tests. We do a lot of work with universities saying, here is some data on risk tolerance and demographics and some other pieces. What can you make of it? So, it doesn't tend to change materially with age. As you get older, risk tolerance tends not to change. What does change is people's perception of risk. I am old. I am terrified. I've been told to be terrified. Therefore, I will be terrified. It doesn't tend to change with education. You think by showing people capital markets and other pieces, you'll change their risk tolerance. That doesn't seem to work either. You may be able to change their short-term behaviour, but not long-term. What drives behaviour is not knowing things. It doesn't seem to be changed by market booms and busts. What happens is they see their friends liquidating, or they see their future melting away. They may know, as you would illustrate, markets have always recovered. There is no circumstance where a diversified portfolio hasn't done better in the longer term. Ever. Since we've got data. That doesn't stop people going, I'm terrified. I need to bail. So booms and busts don't do it. Women are less risk tolerant than men. People in financial services are more risk tolerant than their customers. And what does that do? It means never answer the question which says, when a client looks up to you and says, Bob, what should I do? What would you do if you were me? Never project. Your client is different. The whole notion of the third limb, if you will, informed consent, is it's their decision. The term we use in Oz is that's the legal prophylactic. That's your defence. I took the client through it. This is how we looked at the alternatives. There were trade-offs. This is the one we took in this circumstance. And what do we think changes? Risk perception. If I've got a liability due, I'm going to be infinitely more concerned about the stock market, aren't I? So older people have liabilities due. They don't have other income necessarily. They're going to be much more reliant on capital value. So that's what we've learnt. 20 years, 1.1 million tests. Your clients, every one of them is likely to be slightly different, but only slightly. So, how do we personalise a portfolio? We use a broad set of trade-offs. It goes like this. Risk tolerance is one of three parts. It needs to be offset against actual calculations. What do I need to do to achieve whatever goal I've got? And what happens when it all go to hell? Risk capacity is the single most difficult process you can ever have to deal with. How little amount of money for how long can a client accept responsibility for? Is it going to be like 87? Or is it going to be like 2008? Is it going to be like 28, 29? What do you think the next correction of those three? Which one would you like it to be? Which one is it going to be? And the answer is, we all don't know. So, doing the calculation of risk capacity is scenario testing with your assets, with your circumstances, with your needs to fund particular liabilities. Can we work our way through to make sure whatever sits there has a reasonable likelihood of success? That's our greatest professional challenge, because it's not just the financial assets, it's the other assets and the client's behaviour. Measuring risk tolerance is really easy. The client does it. Our 25-question test takes on average 15 whole minutes to do. Calculating risk required is looking at their spending patterns, their balance sheet and broadcasting. You can probably do that in an hour and a half or 2 hours once you've got the data. Risk capacity, particularly when you've got couples with different goals and aspirations. Where's our advantage? It's about working with clients, making the plan theirs, not the algorithms. It's theirs. And that's where getting risk tolerance right is really helpful. If you use risk tolerance and it varies, then you've added another variable. And so it was with enormous relief when we got enough data to believe that risk tolerance tends not to change. That doesn't mean at an individual level it doesn't change. It just means on average it doesn't. And you imagine we've got a business which is a subscription business. If it doesn't work, we don't get renewals. And I've got a lot of people to talk to. So at any one stage we've got 5,000 or 6,000 users. And largely their testimonial feedback. Do I have any FinaMetrica users here? Is there anybody? Oh, shame. If there was, I could have asked them to give me a testimonial. What they would have said, how cheap it is, and what great value. They're not here to protect my interests. Those three variables can be expanded, and this is a view of the other variables. You may look at this and just go, wow, but essentially this is what goes through your head if you're giving advice. You are weighing off people's risk perception, risk preferences, risk tolerances, risk required, risk capacity, going all the way down here to our portfolio, and then looking at products that solve that, and then starting again. So if you're an advisor, that's effectively what you do. When you build this into a scoring algorithm in a piece of software, do the same thing. When you do it in your own head, who knows what your biases might be? So we've just finished a piece of work with one of the American universities. We set up some case studies. We went to a bunch of advisors and say, how do you calculate the right answer? And then at the end we say, what have you weighed of these 10 variables? How have you weighed them in terms of order? And they split essentially between risk tolerance, risk capacity, and risk required equally. So the primary weighting of a bunch of experienced advisors was different on their fundamental belief of what was the primary driver of giving advice. So let me give you an example of what that means. If you've got a younger person and it's a woman, likely to have a lower risk tolerance, likely to live forever. But if you give them a portfolio that's consistent with their risk tolerance, what will the cost be? Do you have cats in Holland? Yeah? You sell cat food? Yeah? So you're saying to somebody, based on risk tolerance, now the counter argument is I'll give you a portfolio consistent with risk tolerance because you'll live through all the variations more comfortably and you're less likely to make mistakes in your investing. So the long term you'll be better off. Well, here's an interesting challenge. How do you take notes to that effect and how do you test it going on? You might say, you are a younger person, you should have the highest exposure to risky assets that I can give you, and your risk tolerance is irrelevant. What's the right answer? There's a right answer for that client in your methodology. Huh? And if you push your risk tolerance, because if we did this, the bell curve of this room, it would be consistent with risk groups 5, 6, and 7. So in that example I gave you before, I said there was risk group 7 as the absolute return managers. There's 1% of the population. I've been in rooms where it's been 25% of the room. Those are the gung-ho guys. Unlikely to be the gung-ho girls, but occasionally. And they're the ones that everything melts on them. Let me give you an argument. No better. I've been here. My worldview works. Okay, this is just a list of mistakes in risk profiling. I'll leave this with you. I'm just conscious that there's a lot of detail in this, but I wanted to make sure that these slides stand up to some rigor when you read them. Let me give you an example. Asking couples to answer the questions together. That would be a perfect example of a wrong way to do it. Coaching them through it. I know you can't read, you're too stupid, let me read you the questions. Yeah, that would be another example of how not to do it. One of the other ones that's running away, and it seems to be running here in Europe, is using gamble questions. We'll not assess risk tolerance. What we'll do is we'll give you some trade-offs. We'll show you this is gain versus loss, and you answer these questions till you find the tipping point. And they say, this is from Daniel Kahneman's prospect theory, so it has to be right. Utterly flawed. You do Latin, ab initio. There is no link to how people view gambling and risk tolerance, and there is no capacity for most of us to do the calculation in a consistent way. Let us have a little thought experiment to do it, if you will. I'm going to ask you to calculate two numbers, shout out the correct answer after I've asked the question. 4 times 5. 4 times 5? Oh, come on, you can't be Dutch, come on. Okay, 511 times 901. Now, what did you can see what happened there. You know you could do it, but you're not going to do it. Now imagine having a series of questions that hurt. Did that hurt? Of course it hurt. It's the whole notion of gambling questions. They ask you to calculate. What will you do when you can't? And I'm standing there saying, come on, you're going to guess. What are you going to guess? Will it be a number that bears any relationship to anything? No. So, gamble questions, fundamentally flawed ab initio. This will be available shortly. It is one of our, as you can, we write lots of reports. Normally they are considered, balanced, and you'll see there's nothing in the imagery there that would suggest that that's manipulating any emotion at all. I'm waiting for my psychometrician to finish my footnotes. He's in his 9th month of finishing the footnotes. For those of you who've ever dealt with psychometricians or statisticians, nothing emerges unless it's perfect. But this will be published shortly. Okay, just a few other things. These are some developments that we've got underway in terms of risk tolerance. We're doing a whole series of things to tailor our questionnaire and to build integrations. We're developing something called the adaptive test. If you can imagine, we have all of the answers to 1 million plus tests. We can see the pattern of answers. So we should be able to say if somebody has answered these questions this way, these are how the later questions might work. So we should be able to get a more indicative view asking less questions. There is on one side, it enables you to say, I just want to get the low score, figure out the score. The other is you won't get any understanding of what makes clients different. So we have a 25 question test. When we launched the 12, virtually none went to the 12. The only people that use the 12 are the ones that hated the thought of the 25. My clients don't have 15 minutes to fill in. They wouldn't want to do it. Classic example of projecting your own anxiety on top of a client. Now, why is this important? Couple of bits here. How long have I got? By my talking, I reckon I've got... We're okay? Another 20, good. Does this matter? Well, I've just got a couple of bits. The major cause of client dissatisfaction in Canada is failed suitability. So basically, this image here is the volume of complaints in Canada in 2014. What suitability? Nobody told me. You didn't give me a clear view of what was going on. This one, this has got a life of its own. Wasn't designed to work with something as light as an iPad. This is the FCA. This is the UK regulator. And this is their report of complaints of this period, the first half year of last year, 2017. So unsuitable advice, there were 951,000 complaints in the first 6 months. And I go, that's a large number. What sort of marketplace are we in? Oh, there's a market boom. 6-7 years before since any form of correction. 951,000. So I don't know if you have the same here, but our regulator is relatively open. They often turn up at conferences to talk with people. So in November, they were at a conference I was at in Birmingham, and I went to see them. And I said, I'm curious, how do you feel about the 951,000 complaints? And if I've ever seen an example of complacency, there it was. Oh, it's not so bad, they said. We think the practices in the industry are getting better. 951,000 in their own piece for 6 months. And they didn't care. I was sort of, go away, you're a troublemaker. I need to do something like have a cup of coffee, it's more important. Now, if I understand correctly, your regulator will have done something like that, done some audits of suitability and talked about even meeting the regulatory minimum. Have you collected appropriate data? I've certainly in the last 24 hours talked about it. That's the regulatory minimum. What I'm talking about is doing it properly, not the minimum. The regulatory minimum in most countries is appalling. It is the minimal amount that is allowed through the lobbying process. And MiFID II is an abomination for that on a couple of critical issues, and is not untypical of what happens elsewhere. So, let me try and give you a very quick view of MiFID II. Now, this is, as I hopefully, this is not from a practitioner's viewpoint, it is from a curiosity perspective, trying to get the big picture. I spent, as I said, 2 weeks in the UK talking to various people, and I've been looking at this for a while, but here's what I think is going on. Traditionally, the relationship was, there was a dual one. The advisor and the client. The advisor did a due diligence on all of their suppliers, but essentially the liability sat with the advisor. We're now moving to becoming a three-party process. What sits in MiFID are some obligations like when you design a product, you better have a feel, you better understand which market it has been designed to be used in. And you need to have a good idea that it has been used in that marketplace. So suddenly, it's the manufacturer has to have a distributor's understand where it is. There's no technology. What happens traditionally is, as an investment manager, I go and sell it to a distributor or an advisor who then passes it on. There was a very clear line. Remember I said earlier, the real emphasis going forward is for manufacturers to move and understand their clients. That's what the regulation is actually asking them to do. They can't believe their good luck because they've been disintermediated. So we're now going to three-party relationships. Fundamental shift. It doesn't exist in any other jurisdiction. Nowhere else can I find the same set of obligations. Now, my reading of it is that the investment players all have something to play. And I don't know if you have all of these same roles, but you've got fund managers, asset allocators, research houses, platforms, data consolidators, planning software, advisory firms, custodians, all of them, if you think about it, have some role to play in this data movement. I don't know who's going to be the winner or the loser. But in a world where individuals and baby boomers want more, and now we have a whole series of regulations coming through about transparency and reporting, and we've now got fund managers being given a card to play. At the moment, it's simply, what is the minimum that I have to do to stay in business? The next stage is to make those relationships dynamic. How does it play out? It plays out, an extreme example is Vanguard in the US. Vanguard has a great reputation. It now has a great reputation as a financial advisory firm. So what have they done? They've become a vertically integrated business, manufacturer and distributor. Why? They were here because they've been asked to do so in the process. So, the particular bits that I think are of interest are the 5-year data for risk categorisation. Does that ring a bell with anybody? So in the PRIPS and the KIDS, there's an obligation to report 5 years back history to help frame investment expectations. It doesn't take much to take the view that 5 years is nonsense, yes? So what's that designed to do? Confuse clients. So here is a highly prescriptive piece of regulation which is so flawed it is unimaginable. Every PRIPS is obliged, there's even a formula. It will categorically, in a majority of cases, confuse. How did they respond in the UK? Within about a week of that occurring, the regulator said, you have to do it, but you can do anything you like that's better. Can you imagine a regulator who is highly prescriptive at one end is now so principled, saying, we understand how bad it is. Do what you can to mitigate your own risk. Now, I've no notion whether anything's bubbled out here, but that's lie to your customers because we tell you to do it. But if you realise that, do what you can to explain it better. How would you go about explaining it better? Well, guess what? It's called doing it properly. It is giving appropriate advice. Does that advice sit in the regulation? No. Does it sit in education? No. Does it sit in continuing education? No. It sits in a bit of the profession that has said, matching of assets to liabilities is what we do. They're the trade-offs. I need to take this level of risk, I can cope with this level of capacity, and I can sleep at night. Whenever you read the regulation, that's the words you'll find in it, but never a description of how you go about doing it properly. I'm going to skip this bit but leave you to read it. This is some research that Vanguard put together on the benefits of trust. So this is here, but I'll run through that and leave it with you to have a look at afterwards. I just want to, in conclusion, just get to a couple of bits. To give good advice, there are two things with 4 pieces to it. I'll just run through them very quickly. The first one is know your client, know your product. Make sure that you've matched them and you've looked at alternatives. Classic example, you've got a lump sum, should you extend insurance or invest it? Or tell the client, work an extra year. The process of advice. Because in the end you want informed consent. So the 4 proofs are, prove I know the client, prove I know the product, prove I've explored the alternatives, prove I've got informed consent. What sits in MiFID? Full exposure of fees, some version of exposure of risk, subject to 5 years being nonsense. It doesn't take much to extend it to transparency of ownership and other conflicts of interest. So the 4 proofs sit on top of any regulatory obligation you can find. It's the common sense way, if you will, of making sure wherever you sit in the service and supply chain, if you can promote this, it's to your advantage long term. It may be to your disadvantage short term. One of the things that I've now discovered is when you do suitability properly, you re-engineer your business. It is not a case of unplugging your risk test and plugging a new one in and going, it is, wow, I didn't realise what the consequences are, and they are quite substantive. Doing it properly essentially means for many people a complete review of how they go about matching products to clients' needs for the long term. The other piece are around consistency. You need, across your organisation, a scalable suitability process. How you go about it, the three risk tolerance, risk required, risk, that it's done with some consistency of rigour. Remembering that when we talk to individual advisors, they have their biases. So you're going to have to, as an enterprise, you're going to have to untangle that. You need to be able to map with some consistency whatever you do in that to portfolios. Your own view of how to do that. Do you do it by volatility? Do you do it by assets? You need a methodology that's consistent, not finger in the air. That's how we do it. You need a consistent language of risk. When I talk with organisations, they seem to use risk terms utterly interchangeably. Risk appetite, risk tolerance, risk profile, risk preference. Imagine what a client feels. Imagine if you'd gone to a doctor and they measured your blood pressure in the doctor's surgery and had a different way of doing it when you went to the pharmacy, you went on to a specialist, or you were in hospital. impossible to imagine that we haven't found a standardized language of risk in our industry, and we wonder why clients are confused. And then we have to describe risk properly. The capacity. If we don't prepare people for the downside, if we don't do what happened to me in '87, we didn't prepare them. They had every right to be angry. We went right from writing 50 million a month to 1. We deserved every piece of that. On the day of the market crash, I remember going up to see my fund manager and said, "Ian, what shall we do?" And he said, "I don't know about you, but I'm going to the Tandoor for lunch." The Tandoor is one of Melbourne's finest Indian restaurants. This was the personification, if you will, of I don't care. Yeah, absolutely staggering. I still remember, he went on to work for Goldman Sachs. We have to care. Otherwise it comes, maybe not individually, but as a community, we get the regulation we deserve. We wrote this, and Robert has volunteered to work with me to get a local version of this language of risk. I got so irritated by this last year that we just we put this out. 65 risk terms to help provide a framework. The best way to change the world is one mouthful at a time. You're not going to get this from a regulator. It's in your business, your communication. You work outwards. So that there's no intent in this to try and change the world. It's your world, if you want to do it. This just gives you a sense of how all this pulls together. What I'll try to do here, and you'll forgive the vividness of the colours, because I was trying to do this all on my own iPad. The bottom left is commoditised impersonal advice. And the left hand, the vertical axis here, is intimacy. The bit that differentiates yourself when everything else is commoditised, because that's what the technology will do. And intimacy is however you want to do it. Collaborative suitability, there's an intimacy. Personal engagement, cash flow planning, estate planning. There has to be something that gets the individual away from focusing on the money, focusing on the ends. Does that make sense? Without that, without any form of intimacy, all you are is a convenience store, wherever you sit in the supply chain, particularly if you're an advisor. A generalist will always fail when there are no barriers caused by technology. Only specialising, whatever it is, has to be an intimacy piece. So across the bottom here, let me get rid of this, is the level of personalisation of the portfolio. So up here in this left-hand corner, that's life planning, private banking. The big green thing around there, that's your prevention. That's the thing that makes it sticky. People will not move when you've listened to them. Down here, these walls you can walk through. So the more personal you make the relationship, the more valuable the business comes. Why? Because we're all in a subscription business. Subscription business is just the ratio of new business to renewals times your margin. The more you can enrich it, you have this fantastic balance. I've got a great business and I'm being unbelievably professional. What am I doing? I'm actually listening to my clients' needs, helping them articulate them and meet them. It's not that hard. It's just we have impediments to do that. They're often called regulation. The regulation intent is right. It's just not the way it's worked its way through. So the preventative maintenance monthly resurrects itself. It was designed for the American Army, where nobody could make a complicated decision. Please talk with us, talk with me if there's anything there. And if you walk away with this view, this is how you should sleep at night if you do this right. No matter where you are in the service and supply chain, you should feel comfortable that your clients can rest comfortably knowing that they're well fed and they're protected. Thank you very much.